All right, so welcome, ladies and gentlemen, to this wonderful webinar where we want to look at market direction and fair value gap. And of course, you will agree with me that this webinar is one of the most important webinars that you will ever attend because for you to make profit in the market, it has to do strictly to understanding or knowing market direction. Because of course, everybody wants to know what direction will the market take. Because going in favor of the direction of the market gives you your money you're looking for. All the analysis we do in the market, everything we try to analyze or look at in the market is just to decipher the market direction. If we know the direction, then we play along that direction and then we make our money. So today we want to look at how we can determine market direction using fair value gap. So that is what we want to look at. And of course, this webinar is brought to you by DB Investing. And DB Investing is one of the brokers you can use, a platform, very accurate platform that you can use to analyze the market and make money from the market. Of course, I will have to tell you this, that apart from learning different analysis and way of looking at the markets to actually be profitable, the platform you use also matters a lot to enhance your profitability. So that is why I will recommend that you use DB Investing as your platform, as your host, on which you can dive in to make money or make your dream come true. Of course, this is why I want to introduce to you DB Investing platform, our MT5 platform for you to use for trading. Of course, I am no other person but Mr. Shadrach. I am the financial analyst for DB Investing Nigeria. So let's dive down to what we have for today. Understanding market direction, having a clue of the market direction using fair value gap. Okay. Straight up, we want to look at fair value gap. Fair value gap. Now, when we talk about this fair value gap, because I just want to go straight to the point without wasting much time. I'll talk about fair value gap. The thing is, what exactly is fair value gap? Okay, what exactly is fair value gap? Because understanding of this fair value gap is very key. Now, yes, they call it fair value gap. Of course, if you understand, you can call it your own name the way you understand it, so long as you're not violating the principle, the concept. All right. Now, why is it called fair value gap? The truth about the matter is this: the way the market is, most times, in fact, all of the times, whenever the market wants to change a direction, there will be a pressure, either a sell pressure or a buy pressure. That's how the market works. So let's just say the market is just rallying upward, okay? Just going up, going up, going up, going up. And then suddenly, this market that is just rising upward wants to change direction for itself. Most times you will notice an impulsive candle will just drop down like this. I don't know if you've ever noticed that. You'll just see an impulsive candle just drop down. Okay? Let's look at it. The market is just rallying up. Okay? And then it's time to change direction. You just see an impulsive candle straight. Then sometimes it will begin to do a little retracement up again, okay, and then continue the downward trend. Now, this impulsive candle you see here is most times what causes the fair value gap. When there is a sudden buy pressure or sell pressure, and especially if this thing occurs at a swing high or a swing low. we can begin to look at this thing as a change of direction. So if someone says, okay, this market has changed direction, one of the things I look out for is that I want to see an impulsive candle that has created a market imbalance. That market imbalance is what we call the fair value gap. I'll explain what I mean by market imbalance. All right. So a market is trending upwards, and you want to know if that market has changed direction. What will you look out for? Now, some persons who uses the 200 moving average will tell you that, okay, they want to see the market rally and come below the 200 moving average before they can fully ascertain that, okay, this market is now a sell market. All right. People have looked at different things, different parameters with which they can decide that, okay, this market has changed direction. For those who use Elliott wave, there is a way to look at it when they got to wave 5, and then they know that, okay, they do the count, and then they know that, okay, fine, it has changed direction now, perhaps on the downside. Different people look at it differently. But if you're looking at it with the eye of fair value gap, is that if a market is rallying upwards, we want to see an impulsive candle, just a sudden sell pressure, or if it is on the market is dropping, that is selling, we want to see a sudden buy pressure. And that buy pressure or sell pressure is accompanied by an impulsive candle, very long impulsive candle. If we see that, then we will now look. It is that candle that creates what is known as the gap. Let's just look at this. Let's look at this one. This one first. Let's analyze this one. Then after that, we will now go to the chart to begin to find out this fair value gap. Now, if you watch this candle, let's just say this market has been rallying, okay, in a downtrend, right? Coming downwards to this point. Is that okay? Then it forms this candle, then this other candle, and then boom, it gives us this impulsive candle, this bullish impulsive candle, this one. Okay? Right? It has been dropping downwards, down, and then getting to this point, it gives us this impulsive candle. Now, this impulsive candle that is so formed, all right, before we will now say, okay, where is the fair value gap, is that after it gives us this impulsive candle, we will wait for this other candle, this one. So we have 1, 2, 3. These 3 candles. Okay, so the market has been selling, coming downwards, all right? And then suddenly we see an impulse bullish candle. After the impulse bullish candle, we waited, another candle come up again, and then closed. All right? Yes, this candle must close. Now, once this one formed, an impulse candle came up, another candle came again that closed. We will now check. This candle, there was an imbalance. How? Where this candle came and dropped is here. Okay? Part of the body of this one. This other one by the left-hand side, all right? Look at it. Came to this particular point here. Now, between this and this, if you draw a line, there's a gap. This other candle did not breach this gap. By that, I mean, this one did not extend to this particular point. Like, look at this one here. Okay? When we get to the chart, we'll look at it. Okay, this one did not extend to this particular point. So there's a gap that is created. Okay, there's a gap that is created between this candle, okay, and this candle. Okay, and this one is the impulse candle that created the gap. So you look at on the right-hand side and on the left-hand side. But mind you, while doing this, you also look at the next candle by this side, this one, which is called the mother bar. Now, this candle must appear this way. All right? Then we can use this one and this as the gap. Now, what's the essence of this gap? This gap is telling us that there's a sudden surge in buy pressure. Okay, there's a sudden surge in buy pressure. And as a result, the market may have changed a direction for a buy, for a bullish movement. But this is what the market does. You know, when the market pushes upward, after some times, it tends to come back to retest that zone. Now, what we are saying, the essence of this fair value gap is this, is that when a market creates a fair value gap, okay, it will tend to retrace into that gap. All right? And that is the best time to push in for a buy market. That's it. That's the concept of the fair value gap. Number one, the fair value gap helps you to know when market direction have changed. Number two, it helps you to get a good entry for the market because you got to wait for the market to come back to that gap before taking a trade for a buy. And then your stop loss will just be below the zone, or maybe on this below the candle that creates the fair value gap. Okay, very simple concept. Is that okay? When we get to the chart, you will see how simple this concept is on how to use it. Is that okay? Because, and again, you must know how to determine valid and invalid fair value gaps. Okay, so let's come back. Let's just refresh it again, and so that you understand the concept. So what we are saying is that that a market is coming downwards, perhaps, okay, and then there is a sudden bullish candle that rises up rather. All right. Now, once we see this bullish candle, that just an impulsive bullish candle, we'll wait for the next candle to form and close. Okay, that is when we can validate that, okay, this bullish candle has actually created a fair value gap. Now, once this candle closes, this other one closes, then we will now check, okay, there is a space between this candle and the candle by the left-hand side, which is this one. Now, if you notice something, each of these candles seems to dip into the body of this one. Do you notice that? All right. It is not at the edge here. It seems to dip into the body, okay? Into the body of this particular impulsive candle that is creating the fair value gap. All right. So you can see that this one dropped to this point, is kind of deep into this body. And this one also moved in, kind of deep into this body. Then in between this and this, we have the gap. Do you get now? So that is the gap. All right. Now, but while doing this gap, you must take cognizance of the candle, the other candle by this side. All right. We want to see this candle, this position, then this one is valid. But if this candle is like this one here, okay, just close to this other candle by the left-hand side, then we are not going to take the gap from the smaller one. We're going to take it from the bigger one. All right. So that is it. This is very important. Please take note. So that is why we'll talk about this one. So whenever this other candle next to the one by the left-hand side, before the impulsive candle, okay, that creates the fair value gap, okay, if it is above it like this, then we'll use this one, the immediate one, to create the gap. But if it is just by the side like this, side by side, then we'll use the mother bar to create a fair value gap. Okay, because this candle here is called the mother bar. Is that okay? So that is it. So now, like I earlier said, the concept of this fair value gap is simple. When a market creates a fair value gap, number one, it gives us an idea that the market has changed trend, probably to the upside or the downside. Then number two, for you to take that trade, for you to come into that trade, that you must wait for the market to come and retest in the fair value gap. That is where you take your buy trade, and then your stop loss just below the candle, the impulsive candle that creates the gap. That's all. That's what you do. Okay, so now let's get down to the chart and then practicalize this stuff. All right, and then we'll see how it rolls. Okay, so let's move on to the chart. Let's see. Let's see. All right, so guys, this is XAU USD gold. So we want to see how to determine the market direction if we want to say, okay, this market truly have changed a direction, and we want to analyze this direction. This is 4 hours time frame, mind you. So we want to look at this. Now, first of all, I will say this, that if you want to use trade with fair value gaps, that you must understand market swing highs and swing lows. Because most times, if the fair value gap occurs at a swing high or a swing low, it is stronger, more valid. Okay? Now, because sometimes the market can actually invalidate a fair value gap. Okay, but if it occurs at a swing high or a swing low, it is more valid and you can get good entry for your trade. So let's look at this. So for instance, if we look at this one now, you can see that the market has been rallying, okay, in the upside here. Okay, you can see going up, and here seems to be a swing high. Okay, sometimes you can shrink the chart. You see those sharp edges. Okay, that will help you. So when you get those sharp edges, like if we do this to this chart now, if we shrink it, you will see that those sharp edges are points we have to look at. Okay, yeah, those sharp edges. Do you understand now? So I'm just shrinking the chart so that, okay, so those swing highs, those sharp edges is what you look at, okay, the sharp edges. So at that point is where you look at to find a fair value gap. So if we find a fair value gap at those zones or at those points, those sharp edges in 4 hours, then we can now ascertain that, okay, fine. Once the fair value gap is established, you can ask, okay, this market is trending this way or that way, okay? So you understand? So shrink your chart. First of all, identify those sharp edges on your chart. And then at that point where you have those sharp edges, which is this point, okay, these sharp edges, okay, look for a fair value gap. Once you identify a fair value gap, okay, the market has created one, wait for the market to retrace into the fair value gap, take your sell trade or buy trade. That's it. Okay, nice one. Now, what I'm sharing with you is a deeper understanding. All right. Yeah, it's a deep understanding, which I want you to really catch. Yes, which I really want you to catch. And once you have that, you will know that this is what is going on. Okay. So let's push on. Let's push on. So now on this note, when you see this fair value gap, now on the basis of this fair value gap, you will see that now we want to find out where the fair value gap is in this regard, looking at our swing high. Now let's look at this one, or the swing high here, where we want to identify the fair value gap. Okay, now you will see, guys, that from here, which is where we spotted at our sharp edge. Is that okay? Now the market has been rallying in a buy direction, okay? And then just watch it. Let me expand it further so that it becomes very clear. We want to look at that soon. Okay. Let me clear the chart. Okay, so now you can see what this market is doing here. Now, what do you notice? What do you notice? You will see something. First of all, okay, first of all, remember we have looked at the fair value gap. This is an impulsive candle. in the downside. Is that okay? Now, first, you remember the three candles, this one lying side by side to it? Do you remember? All right, side by side, side by side, side by side. So we said this one, okay, and this. So which one is the one that is supposed to create the fair value gap? Okay, so, but if you watch this critically, this is the one we are going to pick. So this one did not really create a fair value gap for us. Do you understand? Because this, it seems to be like the mother candle. Okay. Now this mother candle, or whatever you want to call it, this other one is lying side by side with it. So this, normally we're supposed to take this and this. So this did not actually create a gap for us. So we're not going to take, so this one is invalid. Okay. So that is invalid. So let's look at another one that we are going to look at. All right. So if we shift downwards, if we push down, let's look at this. Let's look at this. Let's see this. Can you see it? Okay. Now, this is fine. If you watch this again, this market did a retracement. Oh, there's an impulsive bearish candle here. Do you get that? Now, but if you look at this, remember we said when the candle by the side, by the left-hand side or the other side, because for a fair value gap to be created, we have to get one candle by the left, one candle by the right. Okay, but the one that's where it begins, there used to be a mother candle. Now, if the mother candle is standing side by side with the candle by the left-hand side, okay, now something of that sort, then here becomes our gap. Okay, the next one too, this, so this becomes our fair value gap. Do you see that? So we have ruled our fair value gap. So this is a valid fair value gap, right? Yes, it's a valid fair value gap. Now, what do we do now? Yes, what do we do? Now, since we have seen this valid fair value gap, now the rule is that wait for the market to retest, to come into the gap, take a sell trade. Simple. Is that okay? So now this gap was created here. All right. Now the market dropped and came into the gap again. Do you see that? Yeah. And then drop for a sell. Now this sell you see here, okay, don't just look at it as a minor sell in the 4 hours. But if you go to, say, 15 minutes, 1 hour, that's a massive sell movement. Is that okay? Yes, from here. So you can see that this market came into the gap again and then dropped. Do you see that? Very simple. Came into the gap and then dropped. Okay, let's look at another one. Let's look at another one. Let me take off clear my chart. Let's look at another one. Where we'll see, oh, sorry. Yeah, we'll see another fair value gap. Let's see. Okay. Now let's look at this. You watch this now. Okay. This market has been rallying up. I've told us that what you just need to do is to shrink your chart in the 4 hours. Then identify those sharp edges in the 4 hours. Then expand it. Look for a fair value gap around that region. When you find it, I tell you, once the market runs and then come back into that gap, take your sell trade or buy trade. That's all. Now look at this one. This is a buy movement to this point, and suddenly there's an impulsive candle. Can you see this impulsive candle? Now this impulsive candle created what is known as a sell pressure. All right. It created what is known as a sell pressure. All right. Now this sell pressure it created. Can you see this? Now here, this one is perfect. Okay, so this is our gap here and this. But do you notice what happened? This is a candle. These are the two candles, 1, 2, 3. Okay, this one is perfect in the sense that this one is lying, this other candle is lying just below it. So it's perfect. All right. So now this is the gap. Do you notice that the market came into this our gap? Do you notice that? And then drop. So while the gap is formed, from this point, there was a sell pressure. Okay. The market came back into this gap. You can see the market came into this gap and then dropped down for a sell massively. So here, what you do is that you wait for the market to come into the gap. That's where you take your trade. Allow the market to come into the gap. Sometimes you can even tap on the upper bar line of the fair value gap, okay, and then reject. And then your stop loss, sometimes I love putting my stop loss just on the top of the bar that created the fair value. Yeah, okay? Because sometimes if you just place your stop loss just above the gap, all right, so that the market might just do a spike and eat you out. But if you drop it on top of this candle here, all right, the impulse candle that created the gap, it's very difficult, except the market is changing the trend again, which is quite a bit difficult. So most times to come into the fair value gap, okay, and then drop back. That's it. So you can see that after creating, the market went into the gap and then dropped massively for itself. Simple. Simple. Okay? Simple. All right. So that is it. Now, the same thing is what is being repeated over and over. There are some cases where the market may not return. Okay? Yes, there are some cases the market may not return into the fair value gap. Don't worry, leave that one. Okay? It is not every market you will take. Just leave that one. Sometimes it will just create the fair value gap and then off it goes. It never returns into the fair value gap. So we are only looking at cases where when we find the fair value gap, the market pushes on, okay, and retraced into the gap. When we see that kind of a case, then that becomes a very good, valid market for us to take that trade. So let's just explore if we can see more of this fair value gap. Okay, let's look at this one here. Can you see this? Can you see this? All right, so we have this one. This is cool. Okay. Yeah, this is cool. So what do we do here? This is an impulsive buy pressure. Is that okay? Impulsive buy pressure. So let's look at it. First of all, we bring in our, what's it called? Fair value gap. Yeah, we have this. And then we have this. Sorry, my distance are not quite accurate. Let me draw it again. So we have this one. We have this one. Okay. Now you will notice something, that the market moved, came back to the gap. Do you notice that? And then from there, boom, it went. Is that clean enough? So what we're trying to say is that once you identified a fair value gap, wait. Allow the market to return. If it doesn't return, don't worry. Let it go. Because when the market returns into the gap, you stand a chance of having a sniper entry, clean entry, and then your risk again is quite reduced. So you just put your stop loss here, okay? Your entry here, stop loss here, and then your profit target could just be at the top here. Maybe the swing high it got to before it retraces into the gap. That could just be your profit target, and then you push on. Once you get to that point, get your take profit and get out of the market. Okay, very simple, very simple. I'm talking about market direction. Identify market direction with the help of fair value gap. Okay, So and I want you to do this. You can spot it out on 4 hours because it is stronger on 4 hours, right? It is stronger on 4 hours. Then you can go to lower time frame like 15 minutes to take your trade or 1 hour to take your trade. Okay, spot it out. So once it comes into the gap, you take your trade, and then your target point could be the high the market reached before it retraced into the gap. Okay, if you can hold it, fine. Sometimes you can just maybe secure profit and then allow trail it to any point where it will reverse. All right, so that is about market direction with fair value gap. It's a very simple technique on how to trade. But the thing here is that, number one, you must know how to identify swing highs and lows. And I said the easiest way that will help you is that when you get to your MT4 chart, shrink the chart, look at the spikes, the sharp edges on your 4 hours time frame, and then expand it, spot at those sharp edges, and then expand it. Then wait for an impulsive buy or sell pressure that will create the gap. Okay. Then once you have identified the gap, allow the market to retrace back into that gap, take your buy or sell trade. And that is how you run this. I guess this simple lecture is pretty clear on how to use a fair value gap to determine market direction and to get good pips in the market. All right. So that is what this particular webinar is for, how to use your fair value gap to determine market direction. I guess this is quite simple and very clear. And this will enhance your profitability. And for those of us who already know how to trade, adding this, okay, you may already have an idea of fair value gap, but may not have the way I approached it, the way I brought it in, you may not be looking at it in that way or in that light, okay? But this may add to you because sometimes you may already know about something, but maybe just listening might just add something, just 1 or 2 things to what you already know. All right, so I wish you guys a very wonderful, peaceful week based using this strategy or this simple system on how to determine market direction. And I wish you guys a successful trading week. Bye for now. See you guys again next week, Tuesday. Okay, same time. And don't forget, this is brought to you by DB Investing. And I am no other person but Mr. Chedrak, the financial analyst for DB Investing Nigeria. Thank you so very much, and bye-bye.